The four most dangerous words in investing is "it's different this time." Well, it could feel different this time. I'm going to help you brace yourself for what could be your head in the stock market and what you should do about it. Got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. I suppose when you meet a doctor just casually, like out in public, maybe a friend of a friend, it's common to say, hey, by the way, after you sort of introduce yourself, hey, can you check out my foot? I've been having this pain when I walk. I'm assuming if I was a doctor, I'd probably get pretty annoyed. I think as financial advisors, we get this from time to time as well. And it's typically either, a amazingly successful financial venture or just sharing some gripes about some finances. And recently I was interacting with a couple socially and it was sort of one such experience where she was explaining just some, an awful financial experience as sort of like this reason why, we don't really invest. Like, I don't really trust the stock market. And sort of the punctuation was, my dad, the last time, blah, 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 whatever happened. But I remember she was sharing this interaction or this incident and said, my dad lost $150,000 in the stock market and gosh, never doing that again. And his lesson learned sort of thing. And of course I empathized and, I get it. And yet at the same time, hopefully I had a good poker face, but in my mind I was thinking, well, if you lost $150,000 and they only had $250,000, well, that'd be a big problem. But if you lost $150,000 and he had $1 million saved up, well, that's painful, but that's just sort of common and sort of par for the course. See, the financial world, certainly the investing world, works on percentages, and percentages can be super tricky. If your investments go down 10%, you need more than a 10% return to get back to where you started. That's one of the unique things, but also markets work on percentages, finances work on percentages, and a percentage of a bigger number is a bigger number. And so that's why this time, right now, and I have no idea what lies ahead in the stock market in the short term. I've said this before, the stock market travels like a leaf in a hurricane. You just really can't know what's behind, what's right around the corner. So you just don't know. However, I do think it's important to brace yourself for what could be different this time, or at least what could feel different this time. Let me explain. Whether you're an experienced investor and you've been saving throughout your career and you're approaching retirement, maybe you're a little bit into retirement, or even if you're new in your investing journey, your financial journey, and you've just been saving up over the past few years, odds are your portfolio is larger right now than it's ever been. And I can say that without knowing your exact financial situation. I can say that with a reasonable amount of confidence because the stock market is at or near all-time highs, which isn't all that unusual. The stock market hits all-time highs, falls from those all-time highs, and then goes on to make new all-time highs. That's the general pattern of the stock market. But it's at an all-time high, and we've been on a 3-year, very, very strong bull market and strong advance in the stock market. The last 3 years have been very strong in the stock market. So likely you've got more invested right now in your portfolio than you ever have. And let me then tie that back to where I started. Therefore, a small percentage, a normal pullback, a normal amount of volatility in the stock market, a small percentage on a bigger number is a bigger number, okay? And while that has benefited you as the stock market has surged the past 12 months, the past 24, really the past 36 months with very little volatility, while that's helped you on the way up because a percentage of growth on a bigger number is more growth, right? It also is going to feel the same. It's going to work the opposite when we do inevitably see volatility again. A percentage decline, 5%, 10%, 15%, 20% of decline on a bigger number is going to feel even bigger than the last time we saw a 5% decline, a 10% decline, or 20% decline. And yes, I know we saw some extreme volatility actually just this spring with the tariff tantrum. However, that was sort of a flash in the pan, right? It was a crisis sort of 3 weeks, and then things recovered. It was one of the fastest rebounds in history. So you might have gotten a statement, you might have checked on your investments, but as soon as you start feeling those strong emotions, the episode was over. And so unusual in that way. And yet, right now, if your portfolio is at the highest level it's ever been, and we inevitably will see a 5% correction or drawdown at some point, a 10% official correction, 15% decline, 20% decline, bear market. Those are features of the stock market, features of investing, not bugs. It's important to brace yourself for what that might feel like so that you can do that fire drill and know the right way to respond. Before I get to 2 practical application points, one of my favorite charts to show, just to help people prepare for, or set expectations, prepare for what could be ahead, is this forward price to earnings ratio report by JP Morgan Chase. Now this shows the expected, the current price of the stock market compared to expected profits or expected earnings. The stock market or individual companies are typically priced based on profits or earnings, and year over year, hopefully those earnings are growing. But if the price of the stock market or the price of the stock grows faster than the earnings, then this PE ratio or this price earnings ratio can expand. And the bigger that number gets, the more that you're paying for a dollar's worth of earnings represents, well, is the stock market cheap? Is it fairly priced, or is it expensive? And you can see here in this chart, the average, the 30-year average is around 17. That average has been going up. So by the way, because this is looking at the past 30 years, that number has been shifting. But you can clearly see that during the late 90s and beginning of 2000, the stock market was trading at a very expensive level. They call that the tech bubble, right? So that was expensive. You can see that during 08, 09, the stock market was cheap, and rightfully so. That was the great financial crisis, and the stock market was down considerably, right? And then you can see that flash from COVID. After we printed $5-6 trillion through it in the economy, the stock market went from, sort of average price to cheap to very expensive overnight. 2022 really burned that off, and here we are. We've actually just recently surpassed those forward price to earnings, that peak that we saw back after COVID. We just surpassed that. So this is just based on forward earnings, price to forward earnings. This is the second most expensive time period in the stock market in history. That's not to say, watch out, the sky's going to fall, but to brace yourself for inevitable volatility, and we might see it sooner than we think. So while it's always prudent to brace yourself for volatility, especially right now with the stock market being at elevated pricing levels, elevated valuation levels, it may be more appropriate to do that fire drill than in times past. And connect that with these statistics. This is actually from the beginning of 2022, an article from the beginning of 2022. It's sort of like telling people, hey, seasons like this, like we're experiencing right now, these are normal. So this is just to the end of 2021, that 95% of all years will see a 5% decline at some point during the year. 63% of times we'll see a correction, a 10% decline. 26% of the time we'll see a 20% drop in the stock market. So 1 out of every 4 years, we're going to see a bear market, and so on. And look at the couple of paragraphs right below those helpful reminders, those statistics, that these averages are skewed higher because of the crashes, the multiple crashes that happened during the Great Depression during the 1930s. So it's magnified based on that. However, occurrences, the frequency of market declines, they are pretty common. And then that next paragraph though, since 1950, on average, the stock market has seen a drawdown of about 13.6% over the course of a calendar year. If you look more recently, it's closer to 14%. On average, at some point, from a high point to a low point throughout a year, we're going to see approximately a 14% decline. We saw that back in the spring. So here's the takeaway. If your portfolio is at or near all-time high, you've never had this much money saved up before in your life. First thing I would have you do is I would take a look at your investment portfolio, and I would at least just mentally calculate, or break out the calculator or your phone and do it. What would a 10% decline feel like on your current portfolio today? What would a 15% decline feel like? What would a 20% decline feel like? What would a 30% decline feel like? And I don't want you to do that math so that you panic or so that you freak out, but just so that you get familiar with it. All right, that's what, that's what percentages would do. This is what the nominal decline would be in these sorts of losses, so that you're familiar and you're prepared, so that you don't have as much of an emotional reaction whenever that does occur, whether that's in the near term or in the long term. And then after doing that, second, I would then want you to run the analysis to do the evaluation of, all right, what's your defense mechanism? What's your portfolio? What's your investment allocation approach to make sure that you're capturing offense for as long as markets are advancing, but that also is going to play defense for you when things inevitably get tripped up or things inevitably turn? Whether that is just relying on diversification or also adding other strategies, either fixed strategies or hedging strategies, to help balance that out. What is your defense mechanism that you're going to use during that time, during these inevitable volatile times, where you're going to say, yep, I don't need to grab the wheel and make any sort of big jerks or changes to it. I've got a plan that's going to capture upsides when they exist, and I've got a plan to play defense when market volatility strikes. And if you're not satisfied, if you're not comfortable that you've got the right plan for defense when it's needed, work with your certified financial planner so that you can add those components right now, so you don't have to have an emotional reaction when the inevitable volatility occurs. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with KWiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.